This session is only 30 minutes, so let's get to it. Why don't you guys start by talking a little bit more about yourselves, what you do, and how big a part data is in that. Regina, do you want to start?
Sure. Yeah. Well, first of all, good afternoon. Excited to be here, and hopefully we'll have a good interactive discussion. I know everybody's just coming back from lunch. So I work at BlackRock in their Aladdin business, and Aladdin is basically a technology system that supports our clients kind of from an end-to-end investment process. So we support all activities across portfolio management, trading, compliance, operations, and risk management to allow our clients to make investment decisions. Kevin?
Good afternoon. I work at Fitch Ratings, and we are in the credit analysis business, delivering our views via credit opinions. So our typical user is profile would be a portfolio manager who covers hundreds, if not thousands, of credits, and typically with a relatively small staff. We have a large analytical staff that covers individual credits and sectors, and therefore are able to do a much deeper dive into the data and the analysis to determine what the credit risk is of the company or the security. And ultimately, our primary job is to assimilate a whole bunch of data into a piece of information or pieces of information that are actionable by those investors. And that actionable piece of information can be a credit rating, whether something's AAA or BBB or single B. But it's also the research and the models that surround it. And one of the things about credit analysis, particularly as it relates to credit ratings, is it tends to be mid to long term in nature, because we're typically rating bonds that have maturities that are multiple years in the future. And so a lot of what we have to do is both figure out what is relevant to the long-term risk, but also figure out what information is available but isn't necessarily relevant. So digging through the plethora of short-term data for signals that might be valuable, but dismissing a lot of it is an important part of our work. So we spend a lot of time not only looking at data, but figuring out what data isn't relevant to our decisions or our investors' needs.
And I guess I probably should have mentioned that obviously to power Aladdin, data is behind everything. It starts with the actual trade data, right? Our clients are using Aladdin to make investment decisions. They actually execute their trades as part of an OMS platform. Those trades then are posted overnight, and overnight we run all the analytics. We run the VAR, the duration, we provide all that. So our clients come in the morning and they have their updated investment book of records, so they can use that to, again, make investment decisions and run risk scenarios and other types of investment processes. And I think, we'll get into this a little bit, but, clients are using these types of platforms through, a variety of ways based upon what their actual underlying business is. So we support asset managers who are obviously managing the money themselves, pension funds who in many cases have some kind of a hybrid model. Some of the assets they're running themselves, others they're using, allocating to third-party managers, insurance companies, and other organizations like endowments and foundations. So really how clients interact with data, how they use these tools very much depends upon their own investment structure, which I know we're going to talk about.
Great. Well, let's talk about the needs and expectations that your clients of your respective companies have. How is that changing given the volume and types of data that just seem to continuously be expanding? Kevin, do you want to start?
Sure. So for us, the key deliverable, as I mentioned, is a credit rating and the research surrounding it. And for a long time, that was enough to satisfy most investors in the way that they used credit ratings or used credit rating services. But that is definitely no longer the case. They still want the rating and the research, but they want much more of the data and the modeling surrounding that decision as well. Sometimes it makes us wonder, are they doubting our decision? But ultimately what they're trying to do is take our decision, and manipulate the data to a degree that they can test, the strength not only of the credit risk, but, of where it fits in their portfolio. So what we're finding, as I said, increasingly is they don't just want the rating and then the financial data. They don't just want then the Fitch adjusted data that says, okay, well, here's the data that we got and here's how we filtered it and here's the information that went into our model. They now want the model itself, and they want the ability to run lots of scenarios around that. And what's really interesting about that is it becomes a two-way street, because if investors are asking for that additional information and they are doing their own scenarios, well, that's data that we actually would like as well. We'd like to know what investors are thinking, how they're stressing different variables. So it's not just about delivering the data and the information and the feedback to investors and delivering it in different ways than we've traditionally been accustomed to, but then trying to understand how and why they're using the data in that manner and trying to use it to enhance our own analysis so that we can continue to deliver, really good actionable information to them in the future.
Yeah, we're actually seeing the same thing. So a slight variation. One of the things I mentioned was that we produce models to help our clients stress test their portfolios. And, right now we have a market environment with extreme volatility, rising inflation. Obviously, the numbers are continuing to concern folks. But, with the Russia-Ukraine crisis and just other events that have happened, geopolitical risk and market volatility, BlackRock has a framework where we are providing these clients with a baseline model where it has basic assumptions. It has, basically, a house view, and then you can take those models and adjust it. So Kevin, exactly to your point, we want our clients to be able to interact with that and come up with their own assumptions, their own views, but be able to leverage the model from a kind of foundational perspective. So we're definitely seeing that. And I agree with your point. It's interesting to see where clients push us, what else they want us to be able to do in our models, additional factors and features that makes our product better. And so we talk a lot about the effect of the community, and that, we all work together to share how clients are leveraging the platform so we can make it better for everyone. The other thing I was going to mention, which I think is interesting, is we're also just seeing a real change in how clients physically interact with the data. So historically, Aladdin was more of a closed architecture platform. Our clients would, like I said, go in to the model. They could do work within the platform. It would spit out an output, and that would kind of be part of the investment process. Now clients want to actually take data out, through APIs or other tools, Excel extracts, and then manipulate it offline, maybe marry it up with other proprietary data or other data sources and enrich it, and then maybe port some of that data back into the ecosystem. So, we're seeing a lot of demand for increased use of APIs, trading data, market liquidity data, underlying data around, credit ratings and other types of security analysis. And so all of that is enriching the ecosystem, and it's really allowing our clients what we want them to do. They are the fiduciaries. They are the investment managers or allocators. It's their data. We want them to own it. We want them to own the results. And so I think it's exciting. I think the only risk, and maybe we'll get into this, is that we just want to make sure that clients understand the implications of that. Data security, data transformation, all of that comes with it, a whole bunch of other topics.
Sure. Quick question about these sort of feedback loops with the clients. Are there certain types of clients, or is it a small group of clients that are really sort of like driving that? Or is this something that is like truly pervasive across many or most of the folks that you're working with?
Yeah, I think we're seeing at all levels. Certainly, the larger, huge institutional investors, people like BlackRock, and your clients are very sophisticated and are very demanding in terms of the additional information that they're looking for. I mean, you do have the other end of the spectrum, which are mom and pop investors, but I would say for the most part, it is something that is common across all of the users. Different investors have different ability to take in the information. They may want it, but they don't have necessarily the tools to always absorb it, and that's why we have different parts of our organization like Fitch Solutions that helps to give them tools to be able to handle that data. But it is pervasive across the investor universe that we deal with.
Yeah. Yeah, I would say the same. I think universally, everyone wants more access to data and data inputs. I do agree it does depend upon the client. I think the larger clients that are more sophisticated, they just have more resources, right? The skill set of their teams, not just in the ability to understand and how to use the data and how to, challenge the models, but actually to physically interact with the data. You look at what's required, and everyone throws out this term citizen developer. They want kids coming out of college to be able to code and have Python skills and all. But there's a positive and a negative to that, right? Is that you're turning over the keys to the castle where clients may not understand the risks of allowing thousands of different portfolio managers or traders or risk teams to be able to take this data in and manipulate it. There's could be inconsistencies and things like that. So we do try to help guide and advise our clients on things like best practices and making sure that they understand those risks. The other thing I would say is just in my position, so I lead the relationship management team across the BlackRock Aladdin business for the Americas. And so that kind of has a wide range across Canada, the US, and Latin America, but also, again, as I was mentioning, different client types, pensions, asset managers, endowments. And it is very unique to see just the ecosystem based upon the regulatory environment you're in. So obviously pension funds are regulated, with a different set of guidelines versus asset managers and others. So some of this is very much driven by not just underlying investors, but also the regulatory environment and kind of what do you need to prepare. And you think about all the things that our clients are being asked to do, with the increased use of derivatives, with 18F4, with more reporting around things like, MiFID in Europe. That's all creating a lot more demand for our clients to get access to this data and know how to manipulate it and use it.
Tell me a little bit about the data itself. What are some things that you guys are prolifically using, exploring, excited about?
I mean, maybe I can touch on some of the new areas that we're exploring as far as data sources. So I was just mentioning, the regulatory environment, for example. I think there's two main areas that we're just seeing an increased use of demand. Definitely the regulatory environment and just overall reporting, whether it's client reporting, board reporting, investment committee reporting. That is definitely driving a lot of the demand. And so obviously being able to support those needs. But another interesting area is, joining up the investment book of record, the IBOR data with ABOR data, the accounting book of record data, bringing that together in one ecosystem is an interesting trend, particularly for clients like insurance companies that are really focused on things like book yield and income. Historically, a lot of the accounting data was used for, financial statement reporting, stat and GAAP reporting, and it was a little bit more on the back end. But now portfolio managers are bringing that information forward earlier in the investment process and wanting to look at book yield and that in a much more integrated way with both, the accounting and the investment data. And I'm sure you see some of this in the analysis. So it's a much more holistic view of the investment decision process. And, for example, we're seeing, within the insurance space, the CECL reporting requirement, which is basically to be able to report current and expected credit loss. You have to do a whole waterfall of your assets where there's going to be credit default, credit rating migration, and then marry that up with accounting information to be able to produce reports to the regulators that then also will determine how much capital you have to reserve against those positions. So a much more like integrated process where it's regulators, it's investors, coming together and in a way informing the community and saying, what's possible, what's not possible. How do we facilitate things that it's not a tax on the process, but it's enhancing the process.
I'll maybe take a slightly different tangent. When I think about what we do, credit analysis, it's at its core, it's financial analysis, and that'll always be the core. But new risks are arising all the time, many of which can have an impact on ultimately on credit risk. And so it forces us to go out and explore those areas of credit risk that we maybe didn't deal with before in a very deep manner because they weren't prevalent. Cyber risk, I think, is a really good example. So 10 years ago, we might have discussed every once in a while in a credit committee an entity's cyber risk exposure. But given the increased prevalence and the increased costs associated with cyber attacks and the binary impact that can have on companies' financial stability, it has become a much bigger part of our analysis. And it started by us doing what anybody does, which is you go out and you ask the people that you interact with, about their exposure to cyber risk. But that gives us a whole bunch of kind of individual but unrelated data points. So recently, we partnered with a company called Security Scorecard. And what Security Scorecard does is they evaluate from a sort of an independent standpoint an entity's vulnerability to cyber attack. It's kind of an open window concept, right? So they look at how many points of potential vulnerability an entity has, and we've gotten that data and work with them to look at that for financial institutions. So we started with our financial institutions rating area because, and banks in particular, because as they say, that's where the money is. And now we get cyber risk scores for hundreds of financial institutions that we rate. And we look at those scores as part of our analytical process, and it gives us a good basis to compare across hundreds of different types of organizations to figure out where we need to dig deeper in terms of exploring the risk related to cyber attacks for a specific entity and potentially ultimately their credit risk. But that's a data point that we never contemplated having before. So it's a new piece of information that we now have to absorb and consider and weigh in our analysis. We haven't touched on ESG. I suspect we will, so I'll pause it. But ESG is another place where there's just the amount of data that we are gathering and that we hold related to those risks is just becoming absolutely enormous.
Yeah, I'm glad you mentioned the cybersecurity. I think that kind of goes to just the overall ecosystem to support data. The compute technology, the physical ability to store the data. We're obviously looking at that, and a lot of our clients want to make sure that we have sound infrastructure and technology. So last February in 2021, we announced a partnership with Snowflake to allow an ability for our clients to work with us to have managed access to their cloud database, to be able to store data through kind of a data warehouse and interact with that data in a more efficient way. And so that's a good example. And we actually moved our whole platform onto the cloud. And again, I think proactively making sure that we have the right system and stability with our own architecture, but also to protect against, many of the things that you talked about. So, whether it's from a due diligence perspective, clients looking not only at all the feature functionality of the platform, but just the underlying stability and resiliency is a big topic, but also then things like what are the extensions of partnering up and being able to support things like a data warehouse, which I think is hugely in demand right now.
What about finding data? Much of this you guys are sourcing on your own, but there's a growing list of providers out there. Can you guys talk a little bit about navigating that on behalf of clients?
Yeah. Well, maybe this is a good time on ESG. I mean, I think that's the new frontier. I mean, everyone knows that we all want to get to the goal of being able to support things like our clients' net zero goals or sustainability metrics, or being able to help them do things like climate risk and transition risk analysis. But, finding that data is extremely hard. And then being able to obviously manipulate that data. We did a couple of things over the last few years. Some of these, our partnerships with organizations like Clarity AI and MSCI and other organizations that provide sustainability data that we can put into our investment processes, and you can use that as inputs. But we also have created some joint ventures with organizations like Baringa and Rhodium to be able to help support deep dive climate risk models, transition risk models, to help our clients do that work. And ironically, I think what's really interesting is I think some of the traditional companies, I think there's statistics like only 20 or 30% of traditional companies actually really report right now in any kind of transparent and consistent taxonomy around things like their carbon footprint. And so it's actually very hard to get ESG data for some legacy companies. But newer companies like venture, companies that are looking for venture capital and funding, they know that part of their story in getting that funding for green technology is actually being transparent. So in order to attract that capital, we're actually seeing a huge amount of really good sources of data from these smaller emerging companies, because they know it's the right thing to do. They know it'll attract the capital, and they're in a way selling their story. So we're finding new sources of data, definitely within the ESG frontier, but we still have a long way to go.
Yeah. Yeah, and I would agree. And we're finding ourselves increasingly partnering with third-party information providers for various data sources. So just like the portfolio manager that I mentioned that has 4 analysts to cover the 1,000 credits in her portfolio, we have 1,400 credit analysts to help them. We have 1,400 credit analysts that need to know about ESG and governance risk and cyber risk and geopolitical risk. We need to partner with companies that have experts and specialists in those areas. So I mentioned Security Scorecard as an example of one company that we're partnering with on cyber risk. Another that we've partnered with is a company called Sigma Ratings that does analysis related to governance risk. So trying to gather all of the public and sometimes private information about corporate governance to compare and contrast the various entities in our rated portfolio to identify early signals of weakness in governance, because we found and the market's observed that's another type of binary event, something that really can cause a company to fall off the map in terms of their performance if there are significant governance issues. And so we work with Sigma Ratings. Another example is we recently acquired a company called GeoQuant that does a geopolitical analysis and gathering information related to geopolitical trends to help us in our forecasts on the sovereign rating side. So we're doing, they're offering to us the same services that we're offering ultimately to our clientele.
So maybe we have only a couple minutes left here, but as briefly as you can you guys talk about the cost benefit, all these things that you guys were just describing come in at an expense in dollar terms, time, types of employees. At the end of the day, it's about the performance. Is it clearly worth it in the immediate? But can you guys talk about that just at least broadly, generally?
Sure. I mean, we were talking about this before, but I think data ultimately is to try to drive alpha, right? And so all of these data sources, all these inputs is ultimately trying to help investors make better decisions. And I think there is an argument of, is this also adding cost? Because the infrastructure and the ecosystem required to manage an environment with all these data inputs, to train the employees, like I said, to be able to do things like, the coding skills, to have the resiliency and the cybersecurity and all that. That's a lot, right? And so I do think it's important. And also the regulatory demands, all this reporting is adding additional disclosure and work. And is it contributing to alpha? And I think, you can liken it to some of the unintended consequences. Think about Dodd-Frank and central clearing and requiring all, additional disclosure and collateralized trading and all that. Very, very important, but does add a lot of additional costs. Or, I think of some of the mutual funds when they were really excited to use derivatives in their portfolio and, they had to now disclose more information or, again, have more infrastructure to support that activity. It really bumped up their fund ratios. And maybe, it makes you think differently about what's your end goal and is the cost benefit really worth it? So I think we look at that all the time. We try to think about how do we create scale and efficiency, just activities that will help our clients take costs out of the ecosystem, not add additional costs.
Yeah, it's certainly expensive and increasingly so. Unfortunately, you can't afford not to look at the data. So you have to figure out ways to process it, analyze it, and draw conclusions out of it as efficiently as possible. And then what I think lots of companies do, including ourselves, is say, okay, well, we've now received a lot of this data that we haven't used and exploited in the ways that we were originally intending, but we can actually do a better job with it. We can make connections where we haven't before. So you figure out a way to almost pay for it or use it in ways that are in addition to the immediate or initial use case, and just creates this hopefully virtuous circle.
Yeah, that's a good point.
Sure, great. Well, that was it, a fast 30 minutes. But thank you so much for spending some time with us and talking about these things.
Great. Thank you.
Thanks, Michael. Thanks for having us.
Thank you.